Hello, everyone. Welcome to today's webinar, Practitioners Insights, Forensic Accounting, Don't Lose Sight of Accounting Amid ESG, hosted by CFA Institute. I would like to take a moment to welcome our audience from around the world joining us remotely. Thank you so much for your participation. I am Pankaj Sharma, Senior Manager, Capital Markets Policy, India at CFA Institute, and will be the moderator for today's webinar. I lead capital markets policy for CFA Institute in India. In my role, I am responsible for advocating policy positions on issues that affect Indian capital markets and the stakeholders across a broad spectrum, including corporate governance issues, ESG and sustainability, use of technology in capital markets, opportunities and challenges on different asset classes, demographic influences, and other important relevant issues. Before I introduce our speaker, I have a couple of housekeeping notes. Today's webinar is for 60 minutes, including the question and answer session, around 40-45 minutes for the presentation, and 15-20 minutes for Q&A. We'll be leaving ample time for question and answer session after the presentation. Please feel free to submit your question throughout the presentation. You can do so by clicking on the Q&A icon at the bottom of your viewer and typing your question in the box. This webinar presentation will be available to view after the presentation concludes in the chat box. We value your feedback deeply, so please complete the evaluation survey before you sign off today. Now it is my pleasure to introduce our speaker for today's webinar, Mr. Vinit Powle. Vinit is a research analyst, vice president at Ambit Capital. He has more than a decade of experience, including 5 years in equity research. Before joining Ambit, he worked with KPMG for 5 years, where he led several assurance engagements across multiple sectors. At Ambit, Vinit now leads research related to a lot of issues and topics, such as forensic accounting, ESG issues, and other areas, including annual report analysis. Vinit is a chartered accountant by qualification. Welcome, Vinit, and over to you.
Thank you, Pankaj. Thank you all for joining in. Thank you, Pankaj, for the introduction. From the very beginning, I would like to set the context over here without wasting any time into this. So the topic which I'll be discussing over the next 35-40 odd minutes would be something which is a must, I would say, because these are aspects, these are nuances which are often overlooked at times. What happens is these are considered to be, at times, hygiene kind of checks. But if you look at them, and if I'll show this in the slides, in the next slides, that how they have a very strong correlation with the investment returns as well. These nuances typically have, kind of received a lot of attention recently because of two things. In the last 2 or 3 things, Indian markets have moved up. There was a lot of momentum which was there. So typically the small and mid caps have witnessed a lot of momentum. There are a lot of turnaround narratives which are happening in this country. Companies, firms which were considered to have or were perceived to be of a certain governance quality are now something which, the investors are believing in the next story. So the narratives are really driving the market. And secondly, I would like to say that, say, for example, now the ESG bit also. The ESG, there is a risk that, the ESG labels are being just slapped just like that. In FY23, around 1,000 companies, because of the SEBI norm, 1,000 companies have already come out with a very detailed report, which was, the first time these companies have reported a very comprehensively on the environmental and social parameters which were there. So the issues which used to be there, like transparency, relative comparison, doing a historical analysis, and so on, that is, I would not say largely done away with, but this is just the beginning. And If you look at the annual reports in the last 2 or 3 years, at least 10 or 12 pages of the annual reports minimum, the companies would have dedicated to the ESG parameters as well. A lot of companies are claiming that they are trying to change a lot of things on the sustainability bit. So having said that, why I'm saying that this has gathered a lot of attention. I would just like to move to the next slide. So if you look at it in this particular slide, the most important diagram would be the top right-hand side pie chart. So if you look at it today, more than 70% of the total mutual funds AUM, which is there, is being managed by the asset management companies who are now signatory to UNPRI. Simply putting it, so that means 70% of the AUM is managed by the AMCs who are now taking sustainability seriously. So simply putting it, I would say that UNPRI is nothing but where the investors sort of enter into some kind of commitment that they will include certain environmental and social considerations in their investment analysis processes or investment decision making. Just to give a very simple explanation for that. In the time series chart, if you see at the bottom, this is how India has evolved. The change has been very, very rapid. If you look from FY10 to FY19 or so, you might be aware that India has seen a lot of accounting blow-ups, governance blow-ups, which have happened. And because of this, regulators, have acted very stringently over the last 10 years. And I would say from FY10 to FY19, most of the changes revolved around governance. India went through a major transition somewhere in FY18, FY19. It happened in phases where they adopted new accounting standards as well, which were directly comparable to the global IFRS. And in the last 2 years now, we have this, SEBI came out with the mandate that straight 1,000 companies, irrespective of their size, have to now report on the sustainability matters as well. So the risk over here is that now in 2 years, a lot of things are being expected from these companies, and everyone is trying to kind of package their annual reports or sustainability reports in a certain way. So it is very critical in the beginning, as I said, that there are turnaround narratives. A lot of small and mid caps have witnessed a lot of momentum. So how do you want to also, kind of pick up these false negatives as well from the entire universe? Because this is the first time that, so many things are happening. So what is actually, what are we doing over here? So there are different perspectives to ESG investing as well. So say, for example, the investors are essentially trying to find great investment opportunities by connecting the narratives which are there with the underlying information. And they, in the process, as I said, these factors are overlooked. So it might happen that they may end up not spotting any fraudulent company or a company which is involved in greenwash. At an analyst level, what typically we are doing at Ambit is we run a quantitative filter. We try to rank these companies on those filters, and the framework itself has a very strong predictability part in terms of predicting some accounting issues or governance red flags and so on. And obviously, ESG takes a bit more because it requires a more bottom-up reading of the annual reports or the sustainability reports, and I'll discuss that. So this is the case. I think largely we should be concerned with how the analysts or the investors are thinking about this. So before I just jump into what are the observations which we are seeing from the top 200 companies in India, for example, what are the basic parameters which the investors or the analysts are considering right now in India on the ESG bit are the ones which I have put in these tables which you see. So environmental would have 7-8 parameters ranging from energy consumption, renewable energy, air emissions, water consumption, and so on. Likewise, social, you have largely corporate social responsibility, or you have employee well-being, or you have customer orientation, and so on. Social is the most daunting, most subjective part of it. And governance, obviously, you see something like board composition, board committees, who are the auditors, has company done any were there any instances of misstatements in the past? Had the company kind of restated the financial statements and so on? So these are the things, the weights, as you can see, differ. I have given a range over here because obviously this will change as per the sector. For example, a cement sector would have a higher weightage on emissions, and a BFSI company, for example, will have a very low weightage on the emissions. They would have other important things like a data security or a customer orientation and so on. So these are the basic things which the investors or the analysts are looking at right now. Within environment also, I would say emissions, waste management and water management is something which the Indian companies are typically talking about. And these are the things where there is a clear, precedence that there is some stress over here and the companies will have to think about it in the long run. Social, as I said, employee well-being probably is the most important part. Also, I would say customer orientation and now also data security picking up. So if I look at the results out of the top 200 companies in India, this is what it is. So if you look at it, just look at this. If I decide to put the companies on a scale of 0 to 100, 0 being the worst and 100 being the best, all the red amber color cells which you are seeing over here, essentially the companies which are getting penalized on these parameters. Typically, if you look at the last line, Univer, these are the median scores. So as you can see, for the three most important parameters which I mentioned on the environment, emissions, water, and waste, the score is just 21, 19, and 15 on a scale of 0 to 100. So we are not even reaching 50 over here. And the ones which are scoring well on these parameters are a BFSI or IT companies. Obviously, there is no risk there. So these companies don't also mind disclosing a lot of information. Obviously, they have better controls, I would say. In fact, cement companies or utility companies which have a higher exposure in terms of carbon emissions and so on, they are doing well because the only reason could be that the investors or the analysts or in general, all the stakeholders have started asking these companies the right questions from the very beginning, like almost 10 years back or 5 years back. So that's the reason they have tried to evolve. But you see most of the sectors, like for example, chemicals, you have heavy engineering, agri-inputs, retail, healthcare, is something which they are not doing. They are not really. So this could be also because that the fact that the companies, this is based on FY22 financials. Now going into FY23, the disclosures would evolve and obviously the score would also change. But largely, it would not be a big swing sort of a change. So this is what it is at India. A lot needs to be done on the environment and the social bit, particularly on governance. As you can see, the scores are fine. I mean, there are still some sectors where you will see those amber red color cells, and I will shortly come to this why that is the case. But as I said, because of the accounting blow-ups, there have been a lot of changes which the regulators have brought in, and that's the reason you see this difference. And the scores are much better versus an environmental and social parameters. But what are we essentially lacking over here is, now we know for sure that there are ESG funds in India also which have been started. There are some 9 funds. I have presented the information on 7 funds over here. Now these funds typically are doing a negative screening kind of an approach. What they are doing is essentially they are culling out metals companies or utility companies. So in a way, I would say that these funds are essentially working as a quasi BFSI or IT funds, rather than saying that I will do a positive screening and I would want to include companies which are doing some progress on ESG, are putting out very specific targets and so on. But that is not the case. The thing which I want to highlight from this chart is, if you look at the median scores, again, on environment, the scores are just the scores. The median scores of all these funds is just 49. Again, not even crossing 50 on a scale of 0 to 100. Social, it is a little bit better. Governance, probably it is the best. A median score of 80, I think, is really good. But because, as I said, these funds are functioning like a quasi BFSI IT fund. So these companies tend to have higher governance standards as well. So obviously the funds are also lacking something, despite the fact that there are BFSI IT companies in these funds. The median scores of these funds is still below 50. So this is the I would say gap, despite the fact that the ESG investing has gathered a lot of momentum. What are the things which the current approach is not able to probably capture? Right now, what we could be missing is something like this. Everyone wants to reach a peak of stewardship, but the way we are approaching to this is like a checklist manager, I would say. Everyone is just filling up the checklist and is wanting to arrive at a score. But say, for example, if I talk about governance, just knowing how much percentage of board is independent, or how many women directors are there, or what is the age distribution in the board and so on. The most important objective filters for governance could be fair representation and capital allocation. So if you simply have a framework to see that how in the past the company has behaved with the minority investors, that gives a much objective picture that way, which will help the investors to make a decision. By fair representation, I mean that what you are representing to the investors and what is actually happening on the ground, and I have one slide on that as well. That is also important. So the only problem right now which I see with the ESG is everyone is taking a checklist approach, and it is still new, it is still evolving. It is not that the companies are doing something wrong or the investors are not getting it. It is all there, but the lens needs to be much different to really kind of find value out of this, because all the ESG parameters which we discuss, as the relative comparisons start coming up in the next 2, 3, 5 years, the investors or the analysts are going to ask questions to these companies, and then essentially the relative comparison will throw there would be a worry whether to invest in a company which has a very high emission intensity, for example, and so on. So this is what is happening in India. Still a lot of things need to be done. Everyone is taking a checklist approach. Not even the ESG funds in India have taken a positive screening approach. They are functioning more like a quasi BFSI IT kinds of funds. So, and why this is important. Now, I will just take you through the fact that why in my framework, the scores are coming to be very low. And if you really want to go that way, as I started in the beginning, that you need to pay attention to these turnaround stories which are happening, the momentum which is there in the small and mid caps and so on, because of these issues which I'll be discussing in the next few slides now. So if you look at this, this is just a case study on the fact that few years back, and a bank which share price of the bank corrected significantly because there were some irregularities which were observed by the regulators. So if you look at it, in the first left-hand side top chart, from FY10 to FY18, the red columnar bar show the growth which Bank 1 witnessed over the period. So the loan book grew at a rate of 32% CAGR between FY10 to FY18. And correspondingly, if you see the right bottom side chart, you would notice that even the share price performance of the bank was like, much above the other bank, which was showing Bank 2, which was showing much slower loan book growth that way. One reason as to why the investors were also getting excited about Bank 1 was the fact that if you look at the top right-hand side chart, just look at this. The fee income as a percentage of asset was, rising significantly from FY13 onwards versus a Bank 2. So the bank was probably very clearly aggressive in booking the fee income upfront. On the other hand, if you look at the credit cost, the way the credit cost has moved from FY10 to FY18, there was no much difference between the Bank 1 and Bank 2. So this is all there. The investors probably miss these details. And if you look at it, if you look at the share price performance, that only corrected when this irregularities were brought up by some regulator or the auditors. Now, if you look at the boards, which we generally tend to follow when we evaluate boards, what details we look at. So if you look at this top left-hand side table, you would notice that, for example, on a Bank 1, so this I'm discussing because these are what governance parameters mean for ESG for any analyst or investor. The board members attended 100% of the meetings which were held in the year. The experience of IDs, the independent directors who were acting on the board of this bank were also acting as directors on other mid caps and small caps which were there. The chairperson of the board was a non-executive director, which is ideally expected if the company wants to set high governance standards for itself. The audit committee was all 100% independent. The chairperson of the audit committee was also an independent director. Now remember, audit committee is something which is essentially entrusted with the job of approving the accounts, discussing the issues with the auditors, approving the related party transactions, and so on. So everything was there. So if you take this approach, but if you kind of ignore the ones which we discussed in the previous slide, this is how the governance will not necessarily help you. You will have to see some outliers on governance, which I will discuss. That is a clear red flag. At least you should go as an investor and ask the company some sort of questions. On the right hand side, if you look at the scatter plot, what I have plotted is, don't get confused with the numbers which are there, but if you just look at the relationship between the accounting scores and the ESG scores or governance scores, which I have highlighted in the bottom right hand side chart as well, the R-square relationship is less than 1%, which means that a company with a very bad accounting quality can have a very strong board if you strictly go as per the checklist approach. Similarly, it could be in a reverse manner also. Company with very high good quality accounts, good quality balance sheet, clean accounts, will have a very low environmental score or governance score as well. So there is no relationship between the fact that if you want to figure out a company which is really bad on governance and the governance scores which you will arrive at by taking this checklist approach. So there is no correlation of accounting scores and governance scores with the overall ESG scores. The bottom left-hand side chart which is there, this is a very common particular thing which we are noting down in India, and that is like, percentage of companies having more than one promoter sitting in the audit committee. Now, ideally, audit committee is something which should be completely independent, ideally, and at least there should be no promoter sitting on that audit committee, because audit committee is like, acting as a medium between auditors and the board. They would discuss the issues with the auditors. They would approve very significant related party transactions. They would observe, analyze the issues which are highlighted by the auditors. In short, they are assigned with the role of protecting the interest of the minority shareholders. Now, as you see, the companies, the small cap companies, which is the amber color bar, almost 1/3 of the companies in India even today have a promoter sitting on the audit committee. So this is a unique case with India, which is there, which is still present. So when you talk about board, what could be the challenges with board? So when you look at board, when we look at the financial statements or the corporate governance reports, typically what kind of observations do we get? Very, very surprisingly, we have noticed that if you look at the company's board, and if you just look at the size of the board, for example, median size of the board in India is, say, for example, 10 members. Now, you will find small caps also having board members to the strength of 16 or 18 also. So that is, again, in my opinion, a clear red flag. Most of the times what you will notice is the board typically consists of all the family members, and just because they have to maintain a balance between the independent directors, that will stand out. You will see a significant amount of skewness also in the way the payments are done to a promoter director and the payments are done to a non-promoter director. Rightly so, promoter has a significant stake in the business. He could be taking a lot of responsibility. But the issues become more glaring when you see the instances like, a director who is much younger, like a 30-year-old is getting paid than more than a professional director or an outside family director who is sitting on the board and getting paid very less or getting no variable pay at all. There could be instances where we have observed that in the last 3 years, when the companies witnessed a very good period of profitability, the executive directors, the MD, CEOs have significantly witnessed an increase in the variable pay. There is no check on the variable pay, for example. There is no check on the cap which is given on the variable pay. So you need to watch out things like that rather than just saying that I will just fill the checklist again over here. You need to figure out these outliers which are there if you are really serious about, and this will have an impact on your investment returns. I will discuss that in the later slides. The other question which often comes is the above two chart. What about the auditors? If auditor is of a certain caliber, can we expect that the financial statements would be of a certain quality? The data suggests that that is not the case. So now, if you look at the left-hand side top chart, you would notice that we have just categorized the auditors basis. These are 4 levels. Now, we have just divided the auditors basis the number of audits which they do. More than 30 audits in the last 10 years, every year, if I look at those, I call it as level 1 auditors. Somewhere between I would say 0 to 20, I would call as level 2 auditors, and level 4 auditors are someone like who audit only one entity and so on. So if you look at it across Nifty, NSE, NSE 200, and NSE 500, a significant chunk of these companies are audited by the level 1 auditors. So if you look at this, what do I mean by this? When I say 64%, so that means that don't get again confused with the term ZOD companies. These are essentially the companies which have weak accounting quality on our framework. So I would say that when we talk about these zone of darkness companies, and I will come at it shortly. If I look at the zone of darkness companies within each of this category, you would notice that 60% of these weak accounting quality companies are still being audited by the level 1 auditors. The pie chart shows that 12 out of 19 blow-ups which have happened in India over the last 10 years, there is 63% where there were allegations of accounting fraud and so on. A level 1 auditor was auditing the entity. So just by the size of the auditor, if you are just getting the comfort on the financial statements of the company, that is not the case. So one is the auditor bit. In the bottom half of the slide, I have discussed something about the RPT, related party transactions, and the group structures which are there. So on the left-hand side chart, you would notice that. So when you're looking at related party transactions also, this chart is a little complicated chart, but what we have noticed is, if you simply look at it, just take consolidated financial statements of any particular company. And depending upon the nature of transactions which they enter into with the KMP entities. By KMP entities, we mean the promoter entities or not joint venture associates or subsidiaries, because they are part of the group and their accounts are anyways being disclosed by the company in some way or the other. But these are entities where we don't have much information. So if you look at the nature of transactions, the main listed entities entering into with these companies, the promoter entities, and if you classify the companies into cash outflows or cash inflows, for example, purchase of goods would be cash outflow, a sale of goods would be cash inflow. We have noticed that where the cash outflows exceed 2% of revenue, there you find a very strong correlation with the accounting quality. Where you observe such kind of a trend, where the related party transactions year on year, the outflows which are happening to the related parties are more than 2% or 5% of the 5% of revenue, there is a good chance that the overall accounting quality of the company would also not be very great. So related party transactions become very, very critical. Always you should see that what is finally how much is the net outflow which is going to to these promoter entities, and the relationship is much stronger with outflows rather than inflows. There are also transactions like where the companies kind of selling something to these promoter entities. There we could not find so much of relationship, but this is something which was there. It's a clear relationship with the outflows. Similarly, we have also observed a strong relationship where the group structures are unnecessarily very complex. So when the group structures are complex, we notice that if I look at companies having more than, say, for example, 50 subsidiaries or 60 subsidiaries, there is a good chance that 50% of these companies where the group structure was very vast. The number of group companies was like exceeding 50 or 60 odd companies. There, almost 50% of the companies were coming out on our filters as very weak accounting quality companies or very bad companies, or very poor accounting quality companies on our framework. So governance, auditors, RPTs, and group structures is something which has a clear bearing on much objective bearing on the overall governance quality of that firm. Only one slide on ENS. What we are typically missing as far as even environmental and social parameters is concerned is that I don't think still we have taken the relative comparison between the companies very seriously. Now, for example, if you look at the table which is there, cement player 7, for example, should be asked questions. So what we have done over here is we have only computed something called as intensity. How much emissions do they kind of produce every year, divided by the tons of cement produced. So as you can see, a cement player 7, the emissions intensity for this player kind of dropped from 737 to 553 very rapidly. The other players were moving at a very small pace. We have not seen anything very special happening in the accounts, in the commentary of the, which is there in the annual reports or the sustainability reports and so on. But when you do a relative comparison like this, you notice that why such a big change? Also, the company is probably most aggressive in terms of setting the targets as well. From where it started, it wants to achieve by 2030 the net zero status, which even other companies are finding it a little bit difficult to achieve. In the bottom slide, you would notice that how these are some sector-specific nuances which one could be missing. Like for example, hospitals. Everyone would talk about the general checklist again, but no one is talking about, for example, what are the contingent claims which are filed by the patients as a percentage of net worth. And you would notice very interesting observations there, that there are companies which have this contingent claims, the cases which are filed by the customers, by the patients on these hospitals. The value of these cases is also going to the extent of 10% of the net worth of these companies. Or there are companies where there is a significant gap between the, in the case of an IT companies, for example, where employee cost is the most important factor. The attrition rate for a particular IT company is very, very high versus the other IT companies which are there. So you need to ask those kind of questions as well. For car manufacturers, simply putting it, other issues like, what are the safety ratings, for example, are more critical on the social parameters rather than, again, going by the checklist. So auto manufacturer one, for example, in our case, if you look at the adult safety or the child safety rating as well, they are just getting like 0 stars, 1 stars. On the other hand, there are peer median, if you look at it, they are getting like 5 stars, 4 stars. So this is again, which we are missing. And I mean, there are these sector specific nuances which one should be careful about. So that's the reason, if you want to figure out the companies which, if you want to figure out a more objective filter, this is how we try to do it. So these are the 11 ratios which are there, which we use. The ratios are essentially, most of these ratios are inspired from book. I've also highlighted the book on the right-hand side of this slide, Financial Shenanigans by Howard Schillit. So there are 11 accounting ratios divided into profit and loss misstatement checks, balance sheet misstatement checks, pilferage checks, and audit quality checks. What is a P&L misstatement checks, for example? Something like a cumulative CFO upon cumulative EBITDA. So we are looking at the consolidated financial statements of these entities. We are taking the last 6 years consolidated financial statements, and we are just ranking the companies. For example, in the BSE 500 companies, this is all ex-BFSI. There are some 420 companies. What we will do is we will rank these companies on cumulative CFO upon EBITDA, such that the best company gets a score of 420, the worst company gets a score of 1. Likewise, we will do it for all the 11 ratios which are there, and we will just take a blended average of that. This is the blended average. We will divide the companies into deciles. The right-hand side heat map shows how do we classify these deciles. So D1 to D5, we call them as zone of safety. D6, D7, we call them as zone of pain. D8, D9, and D10, we call them as zone of darkness. So what are these ratios? Simple P&L misstatement checks. You have cumulative CFO to cumulative EBITDA. It is very easy to manage EBITDA, but it is very difficult to manage a CFO. So if you look at it, if the company has a very low CFO to EBITDA, that means that there could be some challenge with the working capital. There could be a possibility that some fictitious revenue has been booked. You need to see data's aging also probably with that, data's turnover ratios and so on. You have volatility and depreciation rate. Again, the management has a choice over here to decide the life of the asset. If they want to manage profits, they would just want to look at, they would just want to alter the life of the asset so that, the depreciation rates are reduced or increased, and accordingly, the profitability will be affected. Provisioning for doubtful debts, the proportion of debtors more than 6 months. Again, something related to CFO EBITDA. You look at the debtors, you figure out that there are some debtors which are outstanding for a very long period of time. You need to ask questions over there, and these kind of observations would stand out when you apply this framework. Balance sheet misstatement checks. You have cash yields, for example, classic case being Satyam, where you have cash on the balance sheet, but you don't have corresponding interest income coming from that cash. Whether the cash sitting on the balance sheet is bogus. Very important, very powerful filter again to check whether the cash yields are very low, even below the minimum risk-free rates in India which are there. Changes in reserves, this particular ratio is not that critical now after Ind AS or IGAP, so I would not get into that. Third is contingent liability as a proportion of net worth, which is essentially the off-balance sheet risk. The hospital's case, which I discussed, where the claims are being filed by the patients, and you need to figure out that this is an off-balance sheet item, which you will find in the notes to accounts. So what is the proportion of contingent liability as a proportion of net worth? Then comes the most important ones, pilferage checks. Miscellaneous expenses is the proportion of total revenue. Within a profit and loss account, you have something called as miscellaneous expenses. Miscellaneous expenses is the proportion of total. So within other expenses, you have a category of miscellaneous expenses. So if you look at Indian companies, typically, this ratio is somewhere at 2 to 3% of revenue. But there are companies which are also having this ratio to the tune of 4%, 5%. Again, a red flag that way. CWIP to gross block, which is essentially asset under construction to the gross block. If this ratio is high year on year, which indicates that the project is stalled or there was some unauthorized capex which was being made, then you have a cumulative CFO plus CFI, which is cumulative cash flow from operations plus cash flow from investing activities to median revenue. Whether the company was able to generate positive cash flows after investing activities, and all sorts of companies will get penalized over here. The companies which are doing capex but are not able to make free cash flows after that. The companies which are going and making acquisitions, doing acquisitions, but the synergies which were expected out of these acquisitions are not coming back. So such kind of companies will get, because that is the main stream of if the funds are to be kind of siphoned off from the company. Related party advances is the proportion of cumulative CFO, classic one. Remember, we were discussing consolidated accounts over here. So when I say related party advances, these are all the advances which are outside the group to the promoter entities typically. So where you find these advances increasing year on year, that is the challenge. Audit quality checks, you just compare the growth in auditors' remuneration with the growth in consolidated revenue. If it is too high, the growth in auditors' remuneration is very high, you would want to ask questions why it is so. As I was discussing the audit slide in the previous slides, there I mentioned that, how will you find the outliers on audit, for example. So that could be, again, very simple. There are so many companies which are paying like very penny amounts to their auditors, or very significant amounts to their auditors. They would have a very high proportion of fees just for non-audited services and so on. So all these kinds of things, whatever you are seeing over here, you will have to take a period for a little longer, 6 years period, for example. And these are all, unless mentioned, like for example, in cumulative CFO plus CFI or cumulative CFO to cumulative EBITDA, we use 6-year median numbers. And then we rank the companies, because you cannot do this analysis basis just 1 or 2 years. So this is the framework which we use. After this is done, what is the use of it? I would say, if you look at the top right-hand side table, which is there, if I just divide the companies basis the final ranking, D8, D9, and D10, we call them as the zone of darkness companies, the worst on accounting quality as per our framework. And these are the median share price performance of the companies which fall in this decile. So you can clearly see that a D10 company is generating significantly lower return than the Nifty or than the D1 to D5 companies, which are good accounting quality companies. So you pick up any investment horizon, 5-year, 4-year, 2-year, and these are multiple iterations of 5-year, 4-year period. So like, for example, when I say 2-year CAGR, I'm looking at a period from 2003, 2005, 2004 to 2006, and so on. So we have taken a lot of observations to come to this conclusion that accounting quality will have a very significant bearing on the investment returns. Even if you just avoid D9 and D10 companies, you would still probably end up beating the market. I am not considering any valuations over here. I'm not considering any other narrative over here. By simply avoiding D9 and D10, you could see that, or if I have to put it other way, simply investing in a D1 to D5, you'll be able to beat the markets as well. So this is how you would also try to find out, because the framework which we discussed also tries to capture the business turnaround if at all it is happening. So nothing. I think the bottom table which you see are basically the scores. I have plotted the accounting scores at the sector level, and the dots which you see are essentially the dispersion which is there. So in every sector, it is not like if it is an IT company, it would be a very high accounting quality, governance quality company. If it is a realty company, it would be a very bad. Largely, yes, realty companies tend to have lower accounting scores. Heavy engineering companies tend to have lower accounting scores. But if you notice the dispersion, you would see that there are best companies and there are worst companies in every sector which are there. So this is a quant framework which you can use to, kind of come out with a negative list of companies just to avoid. And even when you are doing ESG, without this, doing a governance check is like you will not reach to any objective conclusion from there. These are just simple case studies. I will not take more than 3-4 minutes over here. I will open up the session for Q&A now. Simply putting, this was a textile company. There was a round tripping of money happening in this company, that there was a promoter entity which was there in the middle. The subsidiary is only the subsidiary of the main listed company is selling something to this promoter entity. And the promoter entity is again selling it back to the main listed entity. So the point which I would like to leave over here is that to do such kind of analysis, you have to go back and you have to see the accounts of this promoter entity as well. So when we went back and we saw the accounts of this particular entity, we noticed that the employee cost was not significant. The plant and machinery balance was not significant. So I don't know what kind of operations this entity is doing, but still there is a significant amount of transaction. So if you look at the columnar chart, which is there on the top left-hand side, a significant proportion of purchases which the listed entity is doing, more than 10% is coming from this KMP-owned entity. So you need to be cautious about that. And if you look at the accounts, we had to dig in the accounts by using the website of MCA. We had to pull those accounts and we had to plot everything just to understand that there is no capital employed in this, there is no gross block in this, there is no working capital as such. There is no particular outsourcing cost or employee cost which is there, but clearly, so could not understand what could be the purpose of this main promoter entity. That is the only conclusion over here. Another entity again, the advances to RPTs were consistently increasing year on year. One of the ratio which captures this, if I just put 3 years, so again, a classic case of how the funds are going out of the business in the forms of related party advances. The scatter plot which you see over here, if I have to put this company along with its peer on this particular chart, the red color dot which you see over here is where the company is falling. It is coming in the 9th decile, which is a very bad decile on accounting framework, or a weak accounting quality decile. And you can see the net outflow to RPT as a percentage of revenue on the vertical axis. So clearly, there is a relationship between the accounting decile and the net outflow to RPT as a percentage of revenue. Similarly, the company was having very high unidentified expenses or miscellaneous expenses, which we discussed. Company pays highest fees to its auditors amongst peers. Just look at it, the bottom right-hand side table, if you look at it, the total payment to auditors has been like 17 million, 15 million, 18 million, and so on. I have also plotted the median payments which are done to the auditors by other auto-ink companies or the peers which are there. It is significantly above that. The overall audit fee for this company is even higher. I have only looked at the standalone audit fees. Right from the beginning, the auditors are paid a significant amount. So this is again an outlier. Many people tend to confuse this with the fact that let me divide audit fees as a percentage of revenue. It is not very significant, and hence I'll live with it. But no, that is not the case, because remember the way the auditor is getting compensated for this job. It is a small time audit firm somewhere in India, and if it is getting a chunk of audit fees from this entity, so obviously it would be interested in doing the audit for this kind of a listed entity. Last, I would say this was a logistics company. This is a classic case again on the rising stress in the cash conversion. If you look at this, debtors outstanding for more than 6 months as a percentage of total debtors for the logistic company has reached almost the level of 70%. And they are very reluctant to make any provision on that. So the cash conversion ratio, the CFO to EBITDA ratio obviously is bad. That is getting reflected in very high receivable days. And the unbilled receivable days are also going up. Again, in the bottom, we have this two charts where the company guided some kind of capex before, and then it incrementally increased the capex after the guidance. In a very short period of time, they said that we are revising the guidance by almost whatever 50-60% and so on. So these are largely the case studies. These are some primary data checks which we do. And it is very critical to go on the ground, and actually if you want to get a sense of how the company is conducting the business, we looked at a jewelry company where we noted that primary data check suggested that the company was making cash sales without conducting mandatory or taking mandatory PAN details. There was no offsite data backup facility at that premises, so there was a great risk around loss of data and so on. So these we understand only when we go to the actual where the business is being conducted. So if I have to sum up, these are the 8 factors which I would be very critical about when I'm looking at the governance side of it. Accounting quality, prudent capital allocation, independent directors experience, promoters presence on audit committee, promoters presence on NRC as well, the remuneration setting committee, cozy relationship with independent directors, with the independent directors associated for a very long time. You would want to spot any outliers, as I said, very young members, very old family members, the educational qualification of the audit committee members. I have seen people who are experts in literature or economics also sitting on the audit committee, which is something which you should be careful about. These are some of the books which if you want to kind of note down, if you want to learn more about forensic accounting and how to evaluate the financial statements, these are some of the books which I have put. These are very good books on the subject. Yeah, Pankaj, I'll stop here. I think I have crossed at least 5 minutes from what I had planned.
No worries at all, Vinit. First of all, thank you so much for such an insightful presentation. These are very important topics, and sometimes they get too technical, but you have presented them in a very interesting way, and that's something which is phenomenal. So thank you so much. Now we'll start the Q&A session, and as a reminder for the audience, you can submit your questions through the Q&A link, which is there at the bottom of the screen. I'll start the first one. There is a question on CFO to EBITDA ratio, and it is asking that generally when the company is in growth phase, investment in working capital will be required, and this ratio will not be great for the companies which are in high growth phase. Is that correct understanding? So this is the question, Vinit, for you, that when the company is making a lot of investment in working capital and it's in high growth phase, can we look at this ratio?
So you are right. So obviously that will happen if the company is going into a high investment phase in working capital. You will have these kind of challenges. So you have to be mindful about that. And that is where you will have to put the narrative along with the numbers. If you have strong reasons to believe that company has, I recently looked at a company which has put a new facility, for example, there obviously the inventory balance would go up significantly within a period of quarter or 2 quarters time. So you will face these kind of challenges. The question is, if you look at on a historical basis, whether the company was still able to kind of, this was a regular thing for the company, or this is just one of a thing which is happening currently. So that is something which you will have to figure out. If you have some comfort on that, I don't think it should be taken as a red flag every time.
Exactly. Thank you so much. Vinit, there is also, like you touched upon this, in recent time, let's say last 12 months or so, small and mid caps have done so well in the recent past for the Indian markets. And many of these companies will take a while to catch up on important ESG parameters. In addition, it is also true in the case of many of the large caps that some of the top performers are not that great in terms of perception you have about ESG. Do you think that sustainability is not that big a priority for investors, or what's happening here? Like, is this something which is a challenge for people to understand?
So, I think as I discussed, the few things which I mentioned in the PPT also, that there is not so much clarity. So basic problem with the investors or the analyst community right now is that they are not able to properly evaluate these companies, and probably because of that, this is going into a backseat, I would say. Obviously, the small and mid-cap companies would take some time to absorb these. It has been applicable to straight 1,000 companies, but I think that as data would evolve, relative comparisons would be possible. All these factors which we are discussing, if you keep the ESG part of it aside, these are anyways a very critical things which you would anyways look at when you are evaluating a company. For example, you don't want to invest in a company which is not right on disposing its waste, for example, or is not ethical in that way. So these things, I think the investors need to look at, or the analyst needs to look at it as a regular part of the process. If you are trying to figure out a company which has a much, and this is a much, the companies over here, should be willing to take a much long-term view. These are not like things which are going to happen in a year's time or two. So you are right. I would not say it has, the investors are not taking it seriously, but they are struggling right now with the data constraints which are there. But I think as it will evolve, obviously the best ones would stand out. The best companies will stand out in that case.
Thank you, Vinit. Another question is price to CFO, cash flow from operations, more critical ratio than price to earnings?
I think P is anyways a shorthand valuation parameter. I would say price to CFO is something, again, I have not thought about it as a valuation parameter. It is critical, I would say, but I don't know, because I'll have to see, I'll have to do a relative comparison of these companies as to understand how these things come out. So I don't know. Matlab, price to CFO, probably if the company is again investing and is making a lot of incremental investments in capex or sorry, in working capital, that is where obviously those companies would be, would appear to be very expensive that way. So I don't know whether that would be a right thing to see in every case. So making a statement like price to CFO is more critical than a P is something which I would not want to believe it right now. I'll have to see how the data comes out.
Thank you, Vinit, for such an honest answer. Because like what you're saying is that you have to look at the data and then apply some qualitative assessment to understand that whether we can make this kind of a statement. So thank you so much. The next question is, would the rating of sample companies change if the first ratio, which is CFO to EBITDA, is modified to CFO to net income?
Yes. Now over here also, if you look at it, net income is, when I talk about EBITDA also undergoes through a lot of adjustments which are there. We would not consider other income into this. We would not consider exceptional items into this. So to really assess the operating cash flow generating capability of that company, you need to adjust these things. The day you start making on a CFO to net income basis, you would have a lot of other things coming in your net income, which would not be right, because then you are not comparing to companies' operating cash flow generating capability.
Okay, great. Thanks, Vinit. The next question is that the environmental and governance factors are more quantifiably reported by companies. However, the social factors are looked by a subjective lens. So how to create a framework around the same to objectively define the same?
So as I said that, social is probably the most daunting thing, very, very subjective. And if I have to set a priority as to what comes into the minds of the investors and the analysts first, that would be obviously governance, accounting, quality, environment, and then social. But then in social also, the way we try to approach is that we have identified the most critical factors, like, for example, employment well-being. Now, you talk about how many trainings you have done in the last 1 or 2 years, whether you are increasing the number of training hours, whether you are, the policies which are there on the environment, or as I discussed, one example on employee attrition rate, for example. Now, that could be very, very critical factor as to clearly understand that how is the culture with respect to this employment well-being in the company, rather than just saying that, okay, there is a maternity policy which is there and so on, which usually this checklist tend to do or tend to capture. So both environment, governance, or social, anything which you do, I think you first need to put down that what is it that you want to focus on. So within social, as we do, we first focus on employment well-being. Out of that, most important would be employee attrition or employee training. Gender also is a big problem in India right now. That is a very different thing. There is a lot of scope for improvement on gender equality as well. Similarly, for environmental, first I have to assess the most important thing, which are emissions, water, and waste, because there are risks which are there in India related to these factors as well. And then you have to drill down further to understand as to what is it that you want when you do a relative comparison, how the companies are standing out. So
Right.
I think employee, customer, and IT. I think IT is still again very difficult. On customers front, you would want to probably, if it is an FMCG kind of a company, if it is a kind of a consumer discretionary, consumer durable company kind of a company, you might want to also do a primary data checks to better get a sense of how is the company behaving with the customers.
Right. Thanks, Vinit. The next question is that, can you please reiterate what you mentioned on the changes in reserves ratio?
Okay.
Why does it not have to be looked at? Any red flag or point you can think of? The concept of right of use assets or other comprehensive income?
Okay, so I think these are 2 or 3 questions. First, on reserves. The basic idea of reserves was I want to have a ratio of 1 always. What do I mean by that? The change in the reserves balance in the 2 balance sheet dates, if I take that in the numerator and if I take, say, my net income or profit in the denominator, that ratio should be 1, because whatever profits you make should go to your reserves. Now, the idea to bring in this ratio was there are some companies which also wrote off some bad assets from the reserves. They used to do some merger, they used to do some acquisitions, they used to write off something from the reserves. And the reserves is something which is not often looked by the investors. They focus on the profit and loss account. So if the company is charging something off to the reserves, then the ratio will come below 1. It would be like 0.8, 0.7, and so on. And that is a red flag which is there, which you have to capture. Now, when India has adopted Ind AS, it is so that Ind AS or IFRS doesn't even allow you to pass something through the reserves. Now, if you do a similar kind of adjustment, and there are other things which have come up in the reserve because of Ind AS, like for example, say an FCTR, foreign currency translation reserve. Now, that is also leading to a lot of volatility in the reserves number. You correctly mentioned other comprehensive income, that is again separately mentioned in the reserves. So first of all, it is not allowed in Ind AS. There are certain conditions, there are certain exceptions which are there, where the companies are still allowed to write off something through the reserves, which happens when they go into acquisitions or when they do mergers and so on. But I think it is very rare now in Ind AS, and hence I would not take this ratio so seriously now. And there is a lot of volatility. There are a lot of things which have come up in the reserve because of Ind AS. Any red flag or point you can think on the concept of right of use assets? I have seen all the analysts and the investors ignoring this balance altogether. They want to still compute all the numbers for return on invested capital or return on capital employed by kind of adjusting for these numbers. So very difficult to kind of do any relative comparison basis a right of use asset. The challenge over here is that every company will have a different conditions on lease. You look at these consumer discretionary companies or retail companies, the way they set or they make their lease agreements is very, very different. Someone would have entered into a 5 years lease, someone would enter into a 10 years lease, someone into a much shorter period of lease. So anyways, this becomes a much tedious task then if you want to do any analysis on the right of use assets. Other comprehensive income, personally, I think that this number is not very significant. If you find this number as a very significant number as a percentage of PAT, you should raise a red flag and you should try to understand, because what is it that you pass in other comprehensive income? You have those actuarial adjustments coming in the other comprehensive income. You have something like an equity shares. If the company is invested in equity shares and you have some profit or loss on that, that is passed to other comprehensive income. So again, we'll not see a very significant number coming through other comprehensive income. So probably you can still, avoid that. If it is a very significant number, then you should look at it, what is being passed there.
Thank you, Vinit. The next question is that the exercise which you have talked about is annual. So any observations that one can evaluate from the interim 6-monthly financials reported by companies, such as 6-monthly balance sheet and other financial items? How do you view them? Can you use them for such exercise or assessment?
So there are some ratios which are also very important ratios, like a cash conversion, for example. But at least you'll need to have a balance sheet number. So I would not say on a quarterly basis, but 6-monthly basis, you can still try doing it. Lot of things which we discussed, we are taking from the annual reports like related party advances, or you would say something like a miscellaneous expenses, where you don't have that kind of a disclosure with every quarterly 6-monthly result. But if you look at a CFO to EBITDA, if you look at a cash yield, if you look at, say, cumulative CFO to CFI to median revenue, these ratios, I think surely you can try. If you are able to crunch the data on a 6-monthly basis, for sure should be able to do that.
Great. We are already past our scheduled time, but I'll take one last question. For 11 quantifiable ratios you have mentioned on slide 16, how do you finally arrive at a score to rank them as D1, D2, and so on?
So as I said, say in the BSE 500 universe, X of BFSI, you have 420 companies. So this is a simple relative ranking. Say on a cumulative CFO to cumulative EBITDA, the best company gets a score of 420, the worst company gets a score of 1. It is a simple ranking. And I'm not even doing a sector level classification in this as of now. I can further break down the data into sectors, but as of now, I'm not doing it. So likewise, I will do it for all the 11 ratios. And then what I will do is, once I have the ranks for these companies on the 11 ratios, I will take a blended average of these ratios. Basis those blended average, I will divide the companies into deciles. The best company, obviously, D1 to D5 zone of safety, and the worst D8, D9, and D10 zone of darkness. Simple blended, simple average, simple relative ranking. Just take a blended average and then come at the final scores.
Thank you, Vinit. It is great hosting you for this webinar, and thank you so much for sharing your insights with all of us today. As a reminder to our listeners, please do complete the evaluation survey that has appeared on your screen at the end of the session. CFA Institute and CFA Society India members may claim professional learning credit by logging in their online professional learning tracking tool. Thank you everyone for participating in today's webinar, and we look forward to your participation in our upcoming webinars. Good day, and thank you once again. You may please disconnect now. Thank you very much.
Thank you, everyone.